Okay, we are ready now. So we can begin now. I believe audible, and apart from that, my empty phone now it's working. So I hope you are all in. So let's have around free 30-40 minutes for us to be able to go through this. So this is a little bit of what I'll be doing. At least I can see. You can see it's moving. So because we'll be learning about pips today. So you can also see at least market watch. You can see that the time is 1937 GMT time. So and at least there's some movement. And if I double click here, at least you can see there's movement. Yeah. So I think now we are in. So I'll be introducing you to this. I hope you can see. But let's first finish. Then we'll do an analysis on Euro USD. I also have US 500. US 500 is a plain chart. So we'll also be tackling it on H1 or H4. So let me use H1. And then I'll also introduce something else we usually call period separators. They usually separate the time zones. So if on H1 I use them, you can see these lines. This is to mean this is a 24-hour period. And I can see the futures have been falling. So also, I was supposed to introduce you something else, the Forex calendar, but that we will not do today because usually dealing with fundamental analysis. So I'll mostly dwell on Euro USD, US 500, and gold. I also have the chart on gold here. So you can see it's been on a free fall from 2056 all the way to 2005. Then I'll also explain what these are. It's my trading strategy. It's very simple: demand and supply, the separators, the time zones, the volumes, and also the oscillators. So for now, let's first finish. So whatever we'll be doing, buying and selling, I'll be using this as my practical. So let's continue. So I believe I'm audible enough. And if you have a question, you can always chat or just you can chat there. Yeah. So let's continue. So we were here. So this is now the real thing. What we'll be doing. Minute. Okay, so we start with the base currency. So we were saying the counter currency means it is the essence of our product. So if someone asks you, what do you do in Forex? You purely tell them I buy and sell money, because the only thing we are doing is buying and selling. These are our symbols. So you can see our symbols. So I'm buying euro against dollar, or selling euro against dollar. So all these, they're usually very many, as you can see. There are so many currencies. There is also commodities, etc. There is oil, there is aluminium, there is zinc, even cryptos. They're all there. I have very many. You can see aluminium, zinc, lead, even sugar. The sugar you use, cotton. Oh, so this one I don't know what it is. And also the futures. So the futures like this AUSI 200 is the Australian economy. ES is the Europe economy. Then there is France, UK, US, and the rest and the rest. So let me go back. So the base currency, it is essence of our product. It is denoted on the left side of the pair. We always buy or sell the base currency. So this is the base currency. This one here. So like let's go back to Euro USD. This is the base currency. Then the other one is the counter or the quote currency. So let's continue. So the counter currency is the means of payment and is denoted on the right side of the pair. In a transaction involving the euro versus USD, I buy or sell the euro against the USD, wherein the means of my payment is USD. So I hope you have gotten that. The exchange rate is the price of 1 unit of the base currency. The exchange rate, this now. And when you come to the MT4, you'll be able to see it here as bid or ask. So bid is the price the broker is willing to get you in the market. Now, broker, you cannot do the business without a broker. Then now the ask price, whatever you're seeing here, this now is what the broker is willing to offer you. So I need you to get that. So let's go back. The exchange rate is the price of 1 unit of base currency in terms of the counter currency. Let's take a look at the euro against the USD. So today I'll be dealing with the euro against the USD. I'm hoping this platform does not. Okay, let's continue. So the euro against euro USD is 1.5522, 1.5220. And let's check our price here. So 1.5220. So that's the price. So it keeps changing. I need you to get that. Spread is the difference between buying and selling, the buying price and the selling price. And it's the commission which you pay as currency trader. So that's what you pay, the spread. So when you ask me, how does the broker make money? The broker makes money through the spread. Okay, let me show you here. Minute. I needed to show you the spread. 1 minute. Okay. So I think I had showed you there's a red line and a yellow line. When you click buy, you'll be able to be seeing the moving, buy or sell. And I'll be showing you that. So for example, you want to convert USD to euros at the bank. So you go to the USD to euros. They will tell you that the buying price is 1.56 and that the selling price is 1.49. If you go to a bureau, you'll see the buy versus the sell. If you have your shilling or you have your dollars and wants to exchange them into shillings or dollars into shilling. In other words, in order to buy €1, you would have to pay a little more than 1.5 USD. You can see 1.56, 1.5. If in that very moment you would want to sell your euro, your €1 to the bank will buy €1 at a price slightly lower than 1.5 USD. So if you sold $1,000 to the bank, you receive 641 euros. By selling the euros, euros back, you'll get only 955. So I'm explaining the spread. You paid $1,000 and received 955. So where did the $45 go? So let's come and do the math here. This is the profit of the change. So this is the commission they charge for their customers. This is the only commission that you pay in the Forex market. There are no additional commissions. It is implied by such that we'll always lose because of the spread in the first, second trade. And that's why when you put a trade, let me see. You'll always notice that it's not coming to the positive. It will be a little bit negative when it's starting. Then if the trend is going your end, so that's because of the spread. Some of the brokers also usually have very high spread. So when you're doing this business, the most important thing you always need to look is the spread. Because now without the spread, that's basically the business. Buying the difference between the buy and the sell. The buying rate is 1.56, the selling rate is 1.49. This is where your $45 went. So now I was buying at 1.56. So 1,000 divided by 1.56, I got 641 euros. Then if I do 641 times 1.5, the selling price, I get 955. And that's where 1,000 minus 955, now you get your $45. So pips, another important concept in the Forex market is pips. Pips is in plural, pip is in singular. In the Forex market, the exchange rate rises by pips and falls by pips. So when the market is rising or falling, you will see that price I had showed you. Don't know why this thing has started misbehaving. Let me restart it, because I really needed us to do this. Close program. So PEEP. In the Forex market, the exchange rate rises by pips and falls by pips. For most of the currencies, the pips are denoted 4 places after the decimal point. In other words, if the Euro USD rate is 1.522, then the number of pip is 0. So you can see this one here. If the exchange rate was previously 1.5220 and it rose by 1 pip, the exchange rate would be 1.5221. So you can see 1 pip. So minute trying to. Okay, let's continue. I'll be going slowly because this is very important. This is what we'll be doing every day. Okay. Okay, if the exchange rate fell by 10 pips, we have seen this is 1 pip, it will be 1.5210. So you just take the initial price minus 10. So this is 5220. So this is 20 minus 10. That's why we get 1.52, 1.5210, and so on. The Japanese yen is, however, different. Okay, as we wait. For example, for the Japanese yen, the pip is denoted at 2 places after the decimal point, meaning that if USD JPY is at 88.57, then the pip is equal to 7. If the exchange rate rises by 3 pips, I think it has opened. Just a minute. Yeah, it has opened. Good. So let's just open Euro USD alone. Yes, I think this one will be more than just enough. So I won't open all the tabs because these programs may hang the machine. Let me just do like this. So having some robots here. Okay, just a minute. Okay, I'll go back there. So after the decimal, meaning that if the USD JPY is at 88.57, then the pip is equal to 7. If the exchange rate rises by 3 pips, it will be equal to 88.60. And if it decreases by 27 pips, the exchange rate would be 88.30. So you can see 57 minus 27 is 30. So if it decreases by 27 pips, so I'm just taking this 57 minus this. And then if the exchange rate rises by 3, I'm taking 57 plus 3. I hope you're following. So let's continue. Average daily fluctuation. We had talked about this yesterday. So every day there's always movement. Let me see if this MT4 is open. This average daily fluctuation of Euro USD is about 100 pips a day. One more turbulent days, the fluctuation reaches 200 to 300 pips. On calmer days, the fluctuation reaches 50 to 60 pips. And in terms of percentage, if the exchange rate currently is 5.222, and if I want to announce tomorrow that it rose by 1%, it would be represented by a rise of 152 pips. So this is how you calculate. So if we say that the daily fluctuation of USD is about 100 pips, but what percentage does the Euro USD fluctuate on average? About 0.7% to 0.8%. And in more turbulent periods, around 2%. So you'll hear guys saying market was down today by 1%. That is to mean it lost around 100 pips. Or you'll hear market was up today by 152 pips. On very, very big days, FOMC, those news, you'll hear the market was up 2%. That means the pair gained 2% for that day. It's around maybe 100 pips or 150. From this, we can learn a new and important advantage that exists in the market. So this is very important. The market is stable. So one thing we really love about the FX market is that it's very hard for you to manipulate the market, because imagine you have how many? 20 million people transacting using the shilling or the dollar. Now we are talking of the whole world, roughly 4-5 billion people. So it's very hard for you to know who is buying what at what price at what. Even an AI, it's very hard because all these transactions are taking place, all of them at the same time, within milliseconds, not even a second, milliseconds. One person is buying a car, the other person is buying land, the other person is buying bonds, the other person is buying stocks, the other person is buying exports or imports, the other person is buying fisheries, food. Technically, that's the FX market. It's very, very stable. And I'm referring mainly to the major currencies. So we are talking of the euro, USD, pound. Euro is the Eurozone. We look at the whole of Euro. I love Euro because Euro, you look at the whole European Union. and you're able to see all those countries that are transacting using the euro. When we come to the USD, we are looking at the United States of America. So because this is their primary source of currency, the dollar. We look at the jobs, we look at the interest rates, we look at what else? Consumer price index, or consume, basically how are the consumer consuming? Are they consuming more or less? We look at the balance of payments, exports and imports. How much are they buying from China or selling? We'll also look at oil, which is priced in dollars. So the dollar is very, very profound. We have to be checking on it a lot. Then we have the pound. We look at the Queen's Kingdom. That's the UK. Pound is very, very big because they left the European Union around 2019 there. It was called Brexit, but still remains one of the main financial hubs around Europe, especially London. So pound is very, very important. And now we'll be looking at their interest rates, at the employment rates, retail sales, consumer price index, and all that. What affects the pound? Why would it gain or lose? Yen is another very good one, together with Swiss franc. These two pairs usually act as safe havens. Sometimes when things are really bad, there's a war, there is drought, there is a disease. So investors tend to look for safe havens. Safe havens are these countries whereby they are very stable, that no matter the chaotic or anything that may happen in the world, they still come back stronger because they have been able to stabilize their currencies. Also the interest rates. They were all priced at negative, but Swiss franc was able to move to the positive zone, but yen is still at the negative interest rates. Negative, that means the business there does very, very well. If they're giving, you borrow a loan of 1 million, for example, yeah, but you pay it less, maybe 200,000. So you pay like 800,000 if it's negative. So that means the economy does very, very well. So we'll be looking at the yen also. So did this one open? I think it did. Yeah, it opened. Okay, so this will be our USD. So let me finish, then we come to the practical bit. So I'm seeing today my machine is performing. So this is a stable market with exchange rate fluctuations of 0.5% up to 1.5% throughout the day. There's no possibility that we will trade a currency and lose 10 to 15%. So this is a very, very important point I want you to understand. If the market is moving 1 or 2%, it's very, very hard for you to lose an account. We agree that? Because now it's moving 100 or maybe 100 pips or 50 pips. That means even if I used 0.01, say I came here, I did new order, and here I used this is the lowest lot size here as volume. I buy or sell. So right now, maybe let's say I buy, I've bought, because then I'll move this. You hold on the green line, you can see if this moves 100, 230, that's around 23 pips. I'll make around $2.36. Then here you come and say accept terms and conditions, then you say okay. So now you just hold, then drag. If I drag this will be around 23 pips between now and tomorrow, or between now and the next few minutes. So you can see it's 23 pips, but the profit will be $2.31. If I drag it to the opposite, I'm putting my stop loss. So maybe I can put a stop loss of 14 or 15 pips. Let's put a stop loss of 15 pips. So now the moment I do that, anytime this market moves and hits the red line, this will be my take profit. I'll earn $2.3. But I have to have risk versus reward. In case I'm not online or there is no internet or electricity or something happened, and this position moves against or comes back down, I'll be able to lose $1. So you can see up, if I'll be making up, I'll make $2. If I go back down, I'll be losing $2. So I'm just giving it as an explanation. So it's very, very hard for you to lose an account unless you want to, or unless you really want to make a lot of money. Why do people blow accounts? Because they want to make too much money and they don't have enough capital. Unless you have $100,000 in an account like this one, then that's possible to make maybe $5,000 or $10,000. But now, if you're having $250 or you're having $300, use small, small. So I can train you the art of fishing. The art of fishing is I pick small, small, small for a very long time. I hope you're following. Okay, let's continue. So let's learn the value of every pip within the confines of a particular transaction. If the exchange rate of the Euro USD is 1.5220 and you want to buy 100,000 euros, how many USD do you have to pay? 152, 200. Of course, a second passes and the exchange rate rises to 1.52221. By how many pips did the exchange rate rise? By 1 pip. And what is the current value of 100,000? 100,052 to 10, which is $10 more. So the value of 1 pip in a transaction of 10,000 euros is $1. So this is a little bit of math. So in other words, a transaction of 100,000, each pip has a value of 10 USD. And in a transaction of 1 million euros, we are talking of 100 USD. So how are pips calculated? We take the amount of the transaction that we have performed in terms of the base currency and divide by 10,000. This is the value of 1 pip in terms of the counter currency. For example, for a transaction of 100,000 euros, we divide by 10,000 and we'll get 10. This means that the value of every pip is $10. If we execute a transaction of 30,000, every pip will be worth 3 USD. For the Japanese yen, the calculation is slightly different. We divide the amount of the transaction in terms of the base currency by 100, and that is the value of the pip. So a transaction of 100,000 is the currency pair USD yen, we divide by 100 and the result is 1,000 yen, assuming that the exchange rate is 88. So I won't be going to all that. Let's go down to the size of the spread. Bid and ask. I think we had bid and ask. Let me check. So do you know what the accepted bid or ask is for the Euro USD exchange rate? 3 pips. So in order to perform a transaction of 100,000 euros, which is equal to 152,000 USD, how much commission must one pay? If every pip is equal to 10 USD in a transaction of 100,000 and the spread is 3 pips, we will pay 30 USD in commission, a one-time payment which includes the purchase and the sale. So Euro USD purchase price minus the selling price equals to 3 pips. So the transaction size is 100,000. Then you can see that. So let's go down to commissions. So if to compare the commissions rate paid in stocks, we will notice that in Forex market, the commissions rate are very low. So in this, when you're trading the stock market, I think I had put USD 500. Just a minute. This one is the Fortune 500 companies, US 500, or the biggest companies in the US or all over the world. They're called US 500. And it has started doing that thing again. So let me restart it again as we continue. So the commissions are very low compared to the stock. So commission in exchange, so you can see 3 pips is $3, 3 pips is $30. Commission in shares, 0.5%, you're paying almost, excuse me, 50 euros. 0.5% down here, you're paying almost 500 euros, the size of the transaction. So if you're doing a $10,000 transaction in Forex, 3 pips, you only be charged a commission of $3. But if you're doing a 10,000 euro transaction, 0.5% commission in shares, you're paying a commission of 50 euros, which is a lot. Then if you're doing a transaction size of 100,000 euros, in FX, you will be charged a commission of $30. Then in shares, 0.5 with 100,000 euros, you'll be charged commission of 500 euros. So yeah, so I'll be basing, so this was the US 500 I was talking about. So let's close this strategy test. It's for testing robots. So okay, let's continue. Trading rules. So what are the trading rules? If you trade a certain product and you think that its price will rise, you will buy. So I needed to show you this practically. Here we are back. We were at the euro. So let's see if our euro started rising or what's happening to it. I hope you also have your MT4 there, so that at least you can also take part into this. So you will buy it, and if its price indeed rises, you will profit when you sell it. And if you are long and its price goes down, you will lose. For example, if you trade wood and you think the wood price will rise, you buy 10 tons of wood. When the wood price is 100 USD per ton, and later you sell it when the price rises to you 150 USD per ton, you have profited $500. So basically, if you ask me, how do you make money? Now, that's the most important thing. If you trade wood, you think the wood price will rise, you buy 10 tons of wood. When the wood price rises, is 100 USD per ton, and later you'll sell it when the price hits 50. So you can see 50 times 10, you're making $500 extra. So it's a very, very profitable business if you know what you're doing. If you thought that the wood price would decrease, you would wait until the price reached 50 USD per ton. Then you would have bought the same ton, 10 tons at only 500. So if it's going down, since now I don't have wood, I would wait for the price to go down, then buy more. I'll make another extra $500. So, sorry. Uh, so what are the rules here? A trader who thinks the value of his product is going to rise buys more goods and waits for the price to rise in order to sell. So it's very simple. It's very, very simple. If you think the price is going to go up, what do? You wait, or you buy and hold. But once the price goes really up, you sell. Like what has happened to gold. I really needed we do that analysis. So a trader who thinks the value of his product is going to rise buys more goods and waits for the price to rise in order to sell. A trader who thinks that the value of a product is going to fall rushes to sell the goods and makes most of his money. So there's more money. Short selling, it's called short selling even in stocks. You can just sell because now you have bought when the prices were low. But now when the prices are going up, what do? You buy. Wait for it to gain. Once it gains more, you sell. So traders do not always have to lose everything or gain everything. The trade can be stopped in the middle, and such a situation will be expounded upon further later. Let's translate this into terms of forex market. If you expect the exchange rate of a currency to rise, you will buy it. If you expect the exchange rate of a currency to drop, what will you do? You will sell it. As simple as that. So the sum which you profit or lose depends on the volume of the transaction. So I need you to understand the volume. The one I showed you about 0.01. So the person who entered that trade with a big lot size, say lot 1 or lot 5 or lot 10, that's the more risk you take. Oh, it's back again. Let's close this one. Then this is my USDN. So I'm expecting a big sell on the USDN because you can also see my trend lines here. So then we are at 30, and the reason is uh gold also sold. Just a minute. Damn, this machine is behaving. Anyway, let me finish as it opens. The sum of which you profit or lose depends on the volume of the transaction which you perform. The greater the transaction is, the more you can profit. So the bigger the transaction you make, the more profit you can make. But you will take on greater risk, and the smaller the transaction is, the smaller the profit you will be put. You will have taken on a smaller risk. So smaller risk will mean smaller profit. Great risk wins great profit. So it's all about risk versus reward ratio. How much are you willing to risk, and how much are you willing to gain? So trading currencies is exactly like buying and selling wood, tomatoes, and cucumbers. We buy the goods and we think the price will rise, and we sell the goods and the prices will fall. And you have seen a basket here. I think you can see. Yeah, the tomatoes, broccoli, some milk, eggs, spaghetti, probably, and some yams. I don't know what they are. Some bread there. Okay, let's continue. So I hope you're getting it. Buying and selling. That's what we are doing. Oh, good. It's open. Oh, we're almost done. So trading currencies like buying and selling wood, tomatoes or cucumbers. We buy goods when we think the price will rise. Then we sell the goods when we think the price will fall. Okay, someone is asking a question. Yes. So for us to profit in the market, you need to really understand number one, what you're leveraging on. Say if I have a bigger leverage, we had the last class we talked about leverage. One is the ratio of 200, one is the ratio of 300, 400. And with this broker, I'm going to give you up to how much? 500, right? Yeah, so with Hantech, I'll be giving you guys a leverage of up to 500. But we talked about this and we said leverage is a double-edged sword. Means you can make a lot of money and also you can lose. So if you have say $200 or $250 and you use a bigger lot size, you remember the lot size was when you click here new order, you're going to see 0.01, 0.0 is a micro lot, 0.1 is a mini, there is micro, then there is one lot size is lot one, then there is 0.1 is a mini lot. Yeah, we have a micro and a mini lot. Mini lot is 0.1. So when you click here new order, you're going to see 0.1 or 0.01. But the smallest one is 0.01. So the higher you put those lot size, the greater the risk. So I need you to understand, if you're putting bigger risk means more money, smaller risk, smaller money. So we buy the goods when we think the price will rise, then we sell the goods when the think the price will fall. It's basic demand and supply. There was a time I think here there was a lot of tomatoes, but before that there was scarcity of the tomatoes. So there are people who had tomatoes when people did not have. Then the prices all of a sudden shot up. So those guys made a lot of money on the tomatoes because now the demand for tomatoes was very, very high. It's very, very, very easy to understand because it's basically demand and supply. The demand of a commodity is high, the prices will have to go up. If the supply is a lot, then there's a lot of demand, the price will go down. And then if the demand is less and there's a lot of supply, of course, the price will go down. Sometimes now we are having rains. If it's raining a lot and there's a lot of agricultural produce, if the supply is a lot, like there was, I think last year there was a lot of supply on maize. So the prices of unga or whatever you use to do your ugali should go down. It's basic demand and supply. So also it might rain and destroy some of the harvest. So you realize the commodity will be scarce in the market. Now the price will rise. Another example is oil. When COVID hit, people are not moving. And the reason they were not moving is because half of them, 4 billion people were at home. So that means nobody was willing to buy oil. So oil hit a negative 37 when COVID hit for 9 months. Nobody was moving. Then demand comes back up and oil shoots up to 70 or $60 per barrel because now people won't go back to their jobs. Natuweka nje tena aki nini na wood ema ni hizi bots zinafanya nini hii MP4 ilo iko sawa.